This is the Asia Trade. I'm Haidi Stroud-Watts in Sydney.
And I'm Paul Allen. The top stories this hour. Nvidia's earnings set to be a key market catalyst this week as Bloomberg learns it's planning to raise prices for its AI servers. Alibaba, meanwhile, seeking a $10 billion share sale to fund its AI expansion.
Asian stocks are set for a cautious open. Investors are awaiting fresh US inflation data, and the Fed chairs Jackson Hole's speech for clues on the interest rate outlook.
And a Canadian envoy says US trade talks collapsed over the fine print as it plans retaliation for Trump's 50% tariffs.
Tariff uncertainties, the trade war is back into the headlines. This at a time, of course, when we still have no real clear resolution as to what's going on with the Strait of Hormuz or the situation in the Middle East. So caution abounds as we head into the start of trading. The Nasdaq 100 futures just flicking mildly to positive territory at the moment. But these broader concerns, a rising cost of AI in focus, Nvidia hiking prices, Alibaba launching a $10 billion share sale, attracting quite a lot of conversation around that as well. So all of this is playing into the outlook as we get into some of these tech-heavy markets around the region. Kospi futures are down by close to 2.5% at this point. We are watching the oil price situation as Brent crude last traded lower by 0.8%. They're steadying the US economic isolation plan for Iran in focus. We don't have a great deal of detail over that, so we haven't seen some massive moves when it comes to energy markets, but the Treasury Secretary is set to unveil some more of those details, really with the US looking to ratchet up pressure on US allies given the stalemate that we remain in when it comes to the US-Iran war.
Alibaba is seeking to raise about $10 billion from a Hong Kong share sale. This is as it ramps up artificial intelligence spending. The move, though, immediately spurred criticism from high-profile investor Michael Berry. Let's bring in our China correspondent Min Min Lo in Hong Kong. So, Min Min, tell us a little bit more about this plan. And, it's certainly got its critics. What are they saying?
Yeah, this is the largest follow-on share sale by any company in Hong Kong on record. And the company is planning to issue some 700 over million shares at a 3.6% discount to its Friday's closing price of its ADR. Now, mind you, if you check the ADRs, they were down by about 8.6% or so on Friday. So already a huge hit to the company's stocks post-earnings after it recorded a 75% decline on year when it comes to its profits. So, Michael, there you go. You can see a big decline there. But Michael Burry is saying that he has exited his position in Alibaba some time back and transferred all his position to JD.com instead. And that's an Alibaba rival, of course, in the retail online e-commerce space. And he said that Alibaba has made a lot of inroads in this LLM bloodbath, but it doesn't mean that its ROI will get better. So he initially planned to flip back to Alibaba in a couple of months, but he said he's no longer planning to do that. And the company's shares will have to fall by half to make it attractive for him to enter into the trade again.
I mean, when it comes to the broader AI space, we've heard a lot of chatter about this mystery AI model, Ox Alpha, shrouded in mystery, it seems. Do we know much more about who might be behind this?
Well, we don't have any confirmation, although there is a lot of speculation and a lot of rumors online. There are people speculating that this is a model from China. Some are saying that its architecture is similar to Zhipu's, but nothing is verified at this point. What we know is that they have launched this in stealth mode and provided free access for a limited time of 1 week. So developers are trying it out, and it's getting a lot of positive reviews on places like Reddit, for example. And even the Stripe CEO commented on X, saying that it is, quote, very impressive. And it's interesting, right? I don't know if you've heard, Heidi, about that viral animation film called New Lie in China. A lot of people are comparing this and nicknaming it as New Lie because Ox sort of means or translates to new in Chinese.
I actually really want to see that just to see what all of the excitement is about. That's been sort of criticised as being so bad that it's good. It's a cult classic now. Min Min Lo, our Bloomberg China correspondent, is with us. And getting back to that Nvidia news, right? Bloomberg has learned that some of Nvidia's biggest customers have been told that the prices of its AI service are going up more than 15% in many cases, with memory chip costs soaring. Asian markets will have to price in that news as well, as the Alibaba placement has begin a new week. Our markets reporter Anthony Stevens joins us from Hong Kong. So lots of the same questions, the sort of existential questions over the expensiveness of various things within this AI universe. The Alibaba block, how does that set up the day for us?
Yeah, as you said, there's a lot of moving parts in the AI trade, but the fundamental part is flow keeps coming, right? There is a flood of AI paper coming to the market, and the Alibaba trade actually came really tight compared to where it should be trading, given how much the stock moves, right? It's around a 3 times ADV block. Came in 1 sigma move of the stock, meaning just a 1 standard deviation move for the stock. So it's quite tight, and you can see that there is a lot of demand for AI paper. It's seemingly insatiable, right? We're talking about IPO demand, IG issuance demand, and then private credit demand. So while that demand picture is still very strong, that sets up Asia quite well, at least in the kind of AI trade. But the weight of all of this issuance continues to put pressure on literally everything else, right? We saw the US momentum factor continuing to deteriorate. So the highest risk parts of the market are cracking, even though the market overall in the US is quite stable. And that is being reflected more or less in Asia as these bigger companies kind of find their feet and they return cash to the market in the case of Korea, for example. And we also have the Nvidia earnings in the back end of this week, right? So we get a big update from the top end of the AI trade, and maybe that starts to dominate as momentum underneath starts to pull back. So it'll be a very interesting session in Asia as we try to digest that huge flow alongside the Nvidia price hikes.
Yeah, in terms of those Nvidia price increases, what are the implications for Asia?
Yeah, it's quite complex in the sense that their price hike is around 15%, right? They've been reported to charge this for AI data servers customers. It's interesting because that's closely mirroring the price of the input components. So the stuff that is made by Samsung and Hynix and TSMC and some of the passive makers, right? The entire AI supply chain, has been increasing prices, and clearly Nvidia cannot hold on to that and has to pass it on to customers. So that's an interesting dynamic because we also have some of the listed server makers in Asia, most notably in Taiwan, who will probably suffer on the back of that. Now, what is very interesting in terms of the evolution of this space is how much pricing power does Nvidia have before customers go to their own custom chips, right? Bear in mind that a lot of Nvidia's customers are also making their own custom ASICs, and they're doing that in partnership with Asia. Again, in Taiwan, the likes of MediaTek, for example. So today's response will be very interesting in terms of the foundries in TSMC, the memory makers who are driving this chip shortage and driving this chip price increases in Samsung and Hynix, and to a lesser extent Kioxia and CXMT, but also some of the listed server names in Taiwan. So the whole space will be in play today, especially with some pretty weak leads out of the US.
Market reporter Anthony Stevens there. We're also watching bond markets after what was a very eventful week last week for Treasuries. Looking ahead now to Fed Chairman Kevin Warsh's Jackson Hole speech later this week. Further sell-off in Treasuries are at stake. Meanwhile, the Minneapolis Fed President Neil Kashkari is downplaying worries over rising yields.
There's every indication that the U.S. Treasury market is functioning as it should, that trades are taking place, that there's liquidity in the market. And so that enables us to focus on the federal funds rate as our primary policy tool to get inflation back down.
Let's bring in our Bloomberg MLive strategist, Mark Cranfield. This as we kind of continue to watch the fading impact of, I guess, what we're now calling a Treasury twist, right? There doesn't seem to be a quick fix here for Scott Bessent. What could we hear from the Fed chair that could have an impact?
He's in a very difficult spot. I don't think anybody would like to be Kevin Warsh this week. The market expectations were very high that he would add some clarity to where he sees the inflation impact going, some kind of guidance. Although he's a man who doesn't like forward guidance at all, people were expecting a few words to the investor base to at least give us a bit of an idea of what's on his mind and where he sees things going and the build out for some of these projects that he has at the Federal Reserve going on. So that really may have to take a back step thanks to Scott Bessent, because the way in which the Treasury has intervened in the bond market, they're affecting long-term yields. That really makes the Fed's job a lot more difficult. And Kevin Warsh now may even feel less inclined to talk about the broad markets while this is going on in the background, and investors are trying to digest how big an impact this will have on long-term yields in the weeks ahead. So he may be more reticent than even he has been in the past, and just kick it forward to the next FOMC meeting in September, when it's going to be a very close call between the hawks and the doves there. Already we've heard a few people looking for an immediate interest rate hike, And whether we can get to the majority, it's not too far away. Investors will be watching that very closely. So all in all, it sets up the prospect for some pretty high volatility around Kevin Warsh's speech going into next week, because he may well disappoint on all accounts here. He might not be able to give a clear message on anything, and the market will have to make up its own mind. So if by the end of the week the inflation signals are still high, the economic warfare with Iran and Canada now as well is increasing, that's all going to build into inflation expectations. Bond markets are not going to like it. And by the end of the week, we could be right back where we started before Scott Bessent even decided that he wanted to buy back more bonds.
Mark, in terms of the market making up its own mind, Ray Dalio is advising cutting bond exposure. He likes gold, he likes crypto in an era of currency debasement. How long is this era going to last?
It could go on for quite some time, because it's not just the United States. This concept that countries around the world, particularly major countries, are not reining in their fiscal deficits. Whether you look at Japan, you look into Europe, United States, wherever you look, most governments seem to have come to the conclusion that markets can absorb it. We can get away with not balancing our books for a long period of time. There are very few exceptions in the G10 world, in the wider world. And investors are getting used to it, but they're pricing in a premium for long-term bonds. Until major countries around the world really get to grips and say, yes, we're going to try and rein in our spending, we're going to try and balance the books, that the outcome will be the bond vigilantes will be happy. They'll continue to batter the long end of yield curves, and it will be very much a high volatility game. And people like Dalio will be right. You'll have to look for alternatives, because the more that fixed income looks unattractive, doesn't work as a hedge against stock markets, then you have to look for other things, whether you look at crypto, whether you look at gold, whether you look at some parts of the equity space. Anything else stands up as being an alternative hedge against the bond market.
All right, Bloomberg and Life strategist Mark Cranfield there. Thank you. Still to come. Our next guest says strong earnings have brought US stock valuations back to attractive levels, even as bond yields rise. We talk market strategy with Main Street Research just ahead. This is Bloomberg.
This week, Bloomberg is live at the Jackson Hole Economic Symposium. Tom Keene and Lisa Abramowitz, along with Michael McKee, will bring you news and interviews with Fed leaders, policymakers, and economists shaping global monetary policy. Tune in for continuing coverage and a special episode of Surveillance, August 28th at 9 a.m., including full coverage of Kevin Warsh's first speech to the conference. The Jackson Hole Economic Symposium on Bloomberg. Context changes everything.
Yeah, big event to round out the week, Kevin Warsh's speech at Jackson Hole. And let's take a look at those 30-year bond futures. They are ticking up a little bit. But the 30-year and the 10-year, for that matter, both erased all of the impact of Scott Bessent's so-called Treasury twist last week. We're back to where we were. Taking a look at other risk assets, Kospi futures a little bit weaker by about 2.25% today. We will be keeping an eye on those big tech names, SK Hynix and Samsung, as Nvidia warns some of its major price customers that chip prices may be going up, in some cases by as much as 15%. Nasdaq futures pretty flat at the moment, but the big earnings event of the week, second quarter results from Nvidia. Joining us now is James Demmert, founder and CIO of Main Street Research. And James, I do want to start with that Nvidia story as well. Lifting prices ahead of second quarter results. What are you expecting from these numbers and the stock reaction as well? Because it's been pretty much flat since last quarter.
It has been, and you know what's interesting, and we'll talk about that, is the PE is contracted quite a bit, selling at 20 times earnings and growing at 50% a year. I think that if anybody can raise prices, they can. And of course, they're passing the costs along of their component inflation. But they are the best in the business, and I don't think that their buyers, purchasers are going to flinch. And I think investors are overcomplicating the Nvidia potential results. You simply have to look at the hyperscalers. What they are thinking about spending, or they've guided in the billions, is going to go directly to Nvidia, and we expect those numbers to be far exceeding estimates. And we think it also perhaps would reawaken the confidence in the AI cycle, which has been lost in the last week or two.
How do you approach the AI trade at the moment? When you're being selective, what are you looking for?
Well, I think it's a good question, Paul. And investors really need to think here about valuation, importantly, not overpaying. And that's where you get in trouble in these AI or any technology bubbles. So valuations are very important. And I think that clearly, who are the leaders in different areas, right? SK Hynix or Micron in the memory space. If you're going to go after the chips, you want to look at Nvidia. And then if you look at the hyperscalers, be very careful with your selections there. Obviously, Google has the best tech stack. And then of course, maybe I would stay away perhaps with Meta, which has got all those concerns about the court case, which is significant.
James, I wanted to ask about the sort of broader momentum in this market, right? And we've got a great chart here on the Bloomberg showing that, because obviously this has been such a big driver in terms of the broader AI trade, and we saw a few cracks in that in the last sort of couple of sell-offs that unwind. Does that continue to pressure the strategy, and does that mean in kind of future sell-offs we really start to see the idea of value returning to the fore?
Yeah, Heidi, that's a great chart. And I think it's that investors should really pay attention to this. When you have these technology cycles, if you look back to the 90s or you look at this one, you have these windows of opportunity where earnings accelerate so much more than prices that price earnings contract. And basically you lose the momentum. And, in our view, we're in the third or fourth inning, not only of the business cycle, but the AI cycle. So if you believe that, and you have PEs contracting to way less than growth rates, in many cases, price earnings are half of growth rates, that is an amazing opportunity, and you very seldomly see that. And that's why we would suggest investors want to lean in here to the highest quality names and have that patience, so when that confidence and momentum comes back, they're positioned correctly.
The other factor that's coming into play very aggressively is what's going on with longer end Treasury yields, right? We've seen the Treasury twist. It didn't seem to have much longevity in terms of impact. As we were speaking about earlier, you don't really want to be Fed Chair Warsh this week trying to deliver that message to markets. But how does this end? Because you've said bull cycles can continue at times like this if they can handle this right.
Yeah, investors really need to remember that a gradual rise in rates is a sign that the economies, and it's true globally, are in very good, strong shape. And when you have that kind of growth, you're going to have mild inflationary pressures, gradual, and you're going to need to have gradual increases in interest rates. So this doesn't have to derail the bull market. In fact, the 90s is a good example where we had the 10-year at 6% and inflation at 4.5%. But that's not where Warsh wants it to be. And Besant is obviously concerned about the long end when it comes to the fiscal problems in the U.S. So this is what I think could set up and spook the market here, focusing a little bit too much on our debt problem. That could cause an 8 to 10% correction, which would be an opportunity. But this is business as usual. In a strong business cycle, you're going to see gradual rate increases, and we should. I think Warsh is going to be behind that, but he's in a tough position, no question.
James, in terms of the debt problem, it's very hard to look away. That the numbers are staggering: $40 trillion in US debt, $1 trillion in interest payments. In your view, does this ever get resolved to the satisfaction of the market?
Well, Paul, I've got two comments on that. One is, investors should be careful in this kind of a market. Yes, it could go up for the next 5 years is what we're expecting, even the Dow going to 100,000. But it could also get derailed. If it does, it's probably the U.S. debt problem, so use stop losses. But also, at the same time, we would suggest there is a silver lining for all of us, in the U.S. at least, around this debt. And it's similar to the 90s where the AI productivity growth creates such a rise in corporate profits and corporate tax revenue that it actually fills the hole of this $40 trillion problem, or at least goes a long way to do that. And I think that's the only way out. I don't think we can spend less. We've shown that we're not able to do that. We could grow out of it, and I think that's the Treasury sector is kind of thinking that. But that's really the only way out. So I would suggest that use some risk management tools in this market.
All right, what could possibly go wrong? James Demmert, founder and CIO of Main Street Research. Thank you. Now, Asia's heading into the busiest week of its earnings season. There's about 370 companies in the MSCI Asia Pacific Index due to deliver results. CXMT will report for the first time since its blockbuster IPO, with investors looking for signs the memory chip maker can build on the AI-driven optimism that helped make it China's most valuable company. Makers of AI hardware, from optical modules to printed circuit boards, will also be in focus as Eoptolink and Victory Giant report earnings amid strong sentiment across China's AI supply chain. Also, BYD, PetroChina and Lapu Gold will offer fresh clues on the strength of China's consumer recovery. We have more ahead on the Asia trade. This is Bloomberg. Let's get the latest now from the corporate front. Sinopec has reported a 12% rise in first-half profit as a surge in global energy prices boosted upstream revenues, even as it squeezed fuel sales. Preliminary net income was about $4 billion. Higher prices also increased the value of Sinopec's oil stored in tanks. Chinese chipmaker YMTC plans to raise about $4.9 billion in a Shanghai IPO, following in the footsteps of rival CXMT. The company says it plans to use the funds to expand advanced production capacity and ensure stable memory supply in China and globally. CXMT overtook Tencent as China's most valuable company after its listing earlier this month on Shanghai's Starboard. Shein is expected to raise up to $1.8 billion in a Hong Kong IPO as it enters the final stretch of a long journey to go public. A Monday filing says the fast fashion retailer plans to sell shares at up to 49.5 Hong Kong dollars apiece, and that is before a trading debut on September 1st. Earlier listing attempts in the US and London failed amid heightened scrutiny and geopolitical tensions. The Japanese government is said to be allocating an additional $944 million for chip startup Rapidus. A source says the administration will seek more funds for the contract chipmaker in its fiscal 2027 budget. Rapidus is aiming to compete against the likes of TSMC, with plans to begin producing cutting-edge 2-nanometer chips by next year.
Well, Paul, take a look. We are seeing that dollar debasement playbook getting dusted off, particularly on the back of these comments from Ray Dalio saying sell bonds and buy gold and Bitcoin as this debt crisis continues to loom. He's recommending that investors cut their bond holdings, put as much as 15% of their money into gold to hedge against the risk of that debt crisis. We did see really quite a stellar week when it comes to both Bitcoin and gold last week, and that is just continuing to accelerate there. Bitcoin putting on another 0.25%, as is gold. That softening dollar situation really clearing the path for further gains there. So despite price action already anticipating this narrative, the greenback has been under pressure since about late June, but we are seeing a bit of these dollar-sensitive assets breaking out. This is Bloomberg. Paul, we're watching a couple of key themes that are carried through from the end of last week. One is a sort of fading impact of Treasury Secretary Scott Bessent's what he's calling Treasury twist. So I guess a twist on Operation Twister. And there you have it, that effort to influence Treasury yields was pretty short-lived, and so we'll be watching to see where yields are going from here, particularly as there's sort of broader concerns overall. Could also hear from Fed Chair Kevin Warsh as we get into the Jackson Hole symposium as well. The other side, of course, is we're looking at that AI tech trade. There's the Alibaba block that's going to be causing a bit of consternation, particularly when we get into trading in Hong Kong across Greater China. But Nvidia, not just earnings, but we're hearing that some of Nvidia's biggest customers have been told that prices of servers containing these AI chips are going up more than 15% in many cases. So memory chip costs are soaring. We'll see that play out when it comes to markets like Korea when it opens.
Yeah, not helping the situation is all that debt that's being brought to market by AI companies as well. So much competition in that space right now, and it's all just playing in generally to this debasement trade. I mean, we heard from our last guest, James, talking about the bid for gold, the bid for other safe haven assets in this environment. And if you take a look at gold, that's definitely catching a bid, 4,617 now. Aussie gold miners might be expected to do quite well today as well. One of my favourite metrics is gold in Australian dollars. That's closing in on $6,500 now. Brent crude prices, they're coming off the boil a little bit, but would be perhaps unwise to get used to that. We'll be hearing from Scott Bessent later Monday US time. We're expecting to hear about an economic isolation plan to keep piling the pressure onto Iran. We'll discuss the potential effectiveness of that in a moment. But on the right of your screen, the Canadian dollar, it's down against the greenback. It's down against everything, in fact. It's getting really hammered among all of its G10 peers, and this is why a Canadian envoy says trade talks with the US collapsed last week over the fine print in a potential deal. The US has now imposed new tariffs, while Canada is planning its own countermeasures from September the 8th.
Last spring, I warned that America is trying to break us so they can own us. And I promise that that will never, ever happen. We are keeping that promise. Canada is becoming stronger and less dependent on America. We are already giving ourselves more than they can take away. And we are just getting started.
To think that they're going to go to war with Donald Trump and actually win that war with the U.S., I think it's foolish on their part. I think you're going to see Mark Carney come to the table very, very quickly because it's going to be devastating for his country.
All right, let's get some more on this. We're joined by Bloomberg editor John Herskovitz. So, John, seems like the devil was indeed in that detail when it came to the breakdown in talks. What happened exactly?
Yeah, the devil was in the detail. From the Canadian perspective, what they agreed to seemed to progressively get worse. What the U.S. was offering, some of the points such as what Canada saw as limiting its ability to trade with other countries, and also the use of French language domestically. These are points brought up by the U.S., which really didn't augur well with Canada. Now, the big ticket issues were medium and heavy trucks, but there were a range of issues that went into this. The U.S. had offered concessions, but there is a lack of trust between these two countries, and Canada said what the U.S. offered became progressively worse, and they walked away from the deal because they didn't see what was in writing and what was being promised as two identical things.
John, who feels a bigger impact here?
Yeah, I mean, it's just for the nature of the economies. It's the U.S. is such a large economy. The $20 billion affects Canada more because it's a smaller economy. But in the bigger picture, the two-way trade between these two countries is about $900 billion a year. So it doesn't have a real huge impact on the overall trade. We saw some weakening of the Canadian dollar, but the worry is about an increasing trade war between these two countries that have so much trade, that are so dependent on each other. So that's the worry. We've seen Canada push back against the U.S. We've seen China push back against the U.S. China has much more economic power. Canada has far less.
And John, on a rhetorical point, it's worth pointing out that the word war was in fact used by Canadian Prime Minister Mark Carney. What did he mean when he discussed that in the context of trade?
Yeah, no, he sees relations with the U.S. as fundamentally being altered by the Trump administration, and he's trying to decrease Canada's economic dependence on the U.S. for trade. He's gone out and sought trade deals with other parts of the world. He's trying to diversify the exports that Canada sends. And also there's political leverage. I mean, the overall impact of $20 billion for the U.S. isn't that great, but there are key states that have trade with Canada, Michigan and Ohio, with Senate races this year. The medium and heavy truck supply chains are heavily dependent between these two countries. There are minerals that get traded between the two countries. There's energy as well. So overall, the impact in the U.S. is really not going to be that great, but two states which have races that could determine the balance of the U.S. Congress are going to be at the focus of the trade dispute between these two countries.
Our Bloomberg East Asia Government Editor John Herskovitz there. Well, Saudi Arabia is once again being forced to overhaul how its oil gets to customers around the world as Yemen's Houthis threaten a backup route. The top exporter is sending tankers thousands of kilometres around Africa to avoid a narrow strait near Yemen at the southern end of the Red Sea. For more, Bloomberg editor Michael Heath joins us now. So this is sort of part of really some of the broader changes and shifts that we're seeing around the region as geopolitical uncertainties continue to drag.
Yeah, that's right, Heidi. I mean, just the Houthis obviously have some degree of alliance with Iran, and whether it's directly connected with what we're seeing there or Saudi Arabia obviously has been involved in the civil war in Yemen as well. That this route, another choke point, is sort of coming under threat and forcing tankers to sort of take the long way around Africa, etc., which adds to costs and time and uncertainty as well, and is just another layer on the difficulty of supplying the global energy market. So yeah, it's just another layer of difficulty in an already pretty complicated situation.
Well, we're expecting to hear from Scott Bessent later Monday US time about an economic isolation plan for Iran. Look, Iran has been economically isolated for quite some time, yet continues. How effective can we expect this to be?
It's a really good question, Paul. I mean, the key country, I guess, if you wanted to escalate the existing isolation, you would need to really go after China in terms of, it buys the majority of Iran's oil, but we've obviously got a summit happening next month between President Trump and President Xi, and does the US want to, set off Chinese retaliation on that is a question. Some of the smaller countries like Turkey that have relations with Iran are important US allies. Does it want to impact them? And the other question is, even if it's something else that the US manages to come up with, it's going to take time to have an effect. This is not going to be an immediate impact. I mean, the US is already blockading Iran as it is. We're talking sort of months here, and Iran doesn't really have to worry too much about its people. It's a repressive regime, so it's just a matter of how long it can hold out. And its bet, I suspect, is that it can hold out longer than the US can. So the final option also is that if it does get nasty, Iran can lash out at US allies in the region as well, which again puts pressure back on the US. So it's hard to see how effective it will be, but again, we'll have to wait and see what they do.
All right, Bloomberg editor Michael Heath there. We have more heads on the Asia trade. Stay with us. This is Bloomberg.
Take a look at what we're expecting when it comes to Japanese markets opening at the top of the next hour. Of course, we're watching the impact with the volatility when it comes to Treasury yields at that longer end on JGPs. When it comes to the yen, are hovering at that 159 level against the dollar. The softening that we've seen in the US dollar, that broader dollar debasement trade, has been helping take the pressure off, but Japanese bonds are likely to fall, tracking those moves in US Treasuries. Once dollar yen gets past that 159 level, we're looking at some heavy resistance. That 160 level has become a little bit more distance, at least according to some analysts, including SBI FX Trade there. The fiscal policy stance, though, remaining unchanged, so there's very few catalysts there in terms of where we might see more enthusiastic buying of the yen, if you will. So those are the factors that we are watching, particularly as inflation did see a pickup in the previous week. So we're looking to see if that really adjusts the, or at least backs up the BOJ's case for more aggressive rate hikes. Our next guest also sees a persistence of upward yield pressure when it comes to Japanese bonds, driven by inflation risks and caution over increased government issuance. Joining us now is Ryutaro Kimura, who's a senior fixed income strategist at BNP Paribas Asset Management. Take us through some of the elements that you see as having a meaningful impact here, because we know the Bank of Japan certainly still looks like it won't be rushed into any aggressive action.
Actually, they're OAS market implies about 90% of the probability for the September rate hike due to the rising inflation risk associated with the rising import energy price and the weaker yen, as well as the aggressive fiscal policy under Takaichi administration. But in my opinion, it's a bit overestimation because the BOJ had some challenges before move to the next rate hike. The first reason is that before the July BOJ meeting, investors expect the rate hike pace of every 6 months, but now the expected pace has shortened to every 3 months. But for the BOJ, the current policy rate was 1% is close to the estimated range of the neutral rate from the 1.1% to 2.5%. And Governor Ueda, who preferred the cautious stance on the monetary policy tightening, which could harm the economy, will prefer the more gradual pace than the every 3 months. And if they tighten their monetary policy, which could harm their economic recovery, it will be the responsibility for the BOJ. So I think that at the moment, Wilson will prefer to proceed the tightening more gradually. The second point is that after the FX joint intervention by the U.S. and Japan conducted at the end of July, but now many of the JGB investors expect that their next rate hike will be done under the political pressure from the U.S. Treasury Secretary Bessent, who prefer to stabilize their yen long interest rate, which could spill over to the U.S. Treasuries. But if the BOJ conduct their rate hike, the BOJ rate hike seems to be done by the political pressure by the U.S. authorities. The JGB market participants become more focused on what the Bessent say next. It will damage their dependency of the central bank. So to avoid this risk, I think that the BOJ will postpone the rate hike to October. The last point is that the Prime Minister Takaichi keeps the silence on the BOJ's monetary policy and the FX rate moves after the joint intervention. And some of market participants interpret that this silence means that the implicit agreement on the rate hike in June. But if not, I think that the rushing to the rate hike might increase the conflict between the BOJ and government, and it will be the under risk for the BOJ on the central bank efficiency.
Ryutaro, what's your view then on the yen? Because the softening of the dollar takes a little bit of pressure off. Is this a sort of medium-term impact that we could see?
Yeah, that's an important point to consider BOJ policy management. But thanks to the softening the labor market data in the United States and softer retail data could offset the yen weakening pressure, even if the BOJ skips the rate hike in September, I think. And if the Wilson will send a strong message, like a substantial announcement for the October rate hike, I think that for the yen weakening pressure could soften, I think.
Given the macro backdrop, I mean, what's BNP Paribas' current strategy around the JGB market? Do you stay defensive?
Yeah, this early to purchase aggressively in the JGB because of the persistent upward pressure on long, especially on the long and super long JGBs, that from the administration, the aggressive fiscal policy, and the uncertainty on the future increase in the JGB issuance, associated as well as the risk of acceleration of the inflation. So the recent there are some important change in the bond market, mainly from the United States. The market intervention using the increasing treasury buyback by the U.S. Might show some message on the JGB that the U.S. and Japanese government now become more vigilant about rate hike and will conduct another policy too to suppress yield increase if needed. Therefore, the Japanese authorities, Ministry of Finance, might consider the expansion of their JGB buyback program in this autumn, or shifting the allocation of the new JGB of super long or long-term JGBs to the increasing the mid or short-term JGBs, or the changing allocation of the JGB issuance to suppress the upward pressure on the JGB yield. So I think that the yield move in the future might not one way, and I think that for example the 10-year JGB will move around 3%, not reach to the 3.5 or 4% in the future, I think.
Ryutaro, really great to have you with us. Ryutaro Kimura, who's a senior fixed income strategist at BNP Paribas Asset Management. And you can catch Japan Ahead every Monday at 8:40 a.m. if you're watching in Tokyo. Subscribers can watch us live on the terminal using the TV Go function. This is Bloomberg.
Let's take a look at what we might anticipate at the open in Korea at the top of the hour. We've got Kospi futures off by about 0.7%, though Samsung Electronics an outlier, pointing higher by 0.5%. Of course, one of the big stories of the day is Nvidia telling its customers that chip prices may be going up, in some cases by more than 15%, so this could have some implications for those big chip manufacturers in Korea, Samsung and SK Hynix among them. Also, the Korean won showing a little bit of strength against the dollar, this on the back of the news that both Samsung and SK Hynix are going to be returning a very large amount of cash to shareholders. Asia Stocks reporter Yukyung Lee joins us now with more from Seoul. So Yukyung, tell us some more about the details of Samsung's shareholder return program.
Yeah, this is going to be the biggest story of the day. On Friday after market close, Samsung announced the 110 trillion won or $80 billion worth of shareholder program in 2026. And that includes 30 trillion won in cash dividends during the third quarter. However, the company did not give the details, the proportion allocated to share buyback and cancellation, saying those details will be determined during the board meeting in January 2027. So during the post-market, we saw Samsung shares erasing earlier gains after this massive shareholder return package was announced. In apparent investor disappointment, some of the investors have found these details a bit underwhelming.
So was that the main reason that investors were disappointed? They just wanted to know more?
So it's about also managing expectations. Before Samsung announced its massive shareholder return package, there was a local media report on Korea Economic Daily that says Samsung's return program will amount to 150 trillion won versus 110 trillion won that was actually announced. I think the biggest reason also the investors were disappointed was because Samsung did not give the exact proportion that were allocated to share stock buyback and cancellation cancellation. That's in contrast to SK Hynix a few days earlier when the company, the smaller rival, announced the 40 trillion won worth of share buyback and cancellation program over the next 3 months. Unlike SK Hynix, Samsung said investors should wait until January to find out more about the details of the shareholder share buyback and cancellation program, which was the key points that investors were waiting to hear from. So it's about managing expectation, and it's also about the proportion of how much of the 110 trillion won will be spent on share buyback and cancellation.
Yukyung, can we add another question to that list as well? How long is this policy going to run for? Can we anticipate that this is it going forward as long as the chip supercycle lasts?
Yeah, so about the shareholder return program, Samsung has been saying that 50% of the free cash flow will be returned to shareholders. Now, investors, the 110 trillion won figure represents, this is in line with Samsung's 50% return of free cash flow to investors. So if that 50% return of free cash flow promise is kept for the next 3 years, investors are expecting much bigger shareholder return program over the next 3 years. Now those details will also be announced in January board meeting in 2027. So investors should wait for another 5 to 6 months.
Bloomberg Asia stocks reporter Yukyung Lee there in Seoul. Let's get you a quick look at how we're setting up just a few minutes away from the start of trading here in Sydney. Of course, Japan and also Korean markets opening as well. Looking like a cautious start. We do have the Nvidia earnings to look ahead to, but also these reports over the price hike as well as the Alibaba block that we'll be watching as we get into the start of trading across Hong Kong and Greater China. Sydney looking like we'll buck the broader trend of caution. Upside being seen. Futures up by 0.5%. Of course, not a tech-heavy name here. We'll be watching for some of the gold miners given that we continue to see that dollar debasement trade gold. Bitcoin continuing to extend those gains after what was a pretty spectacular run already last week. The market opens are next. This is Bloomberg.
This is the Asia Trade. We're counting down to Asia's major market opens. And Heidi, going to be a busy week around the Asia Pacific for earnings.
Yeah, busy week for earnings, busy week when it comes to Fed speak. Kevin Warsh fronting Jackson Hole Symposium, of course, the Jackson Hole Symposium, I should say, at a time where there's so much scrutiny when it comes to what's going on with the Treasury markets after the Treasury twist that we got from Treasury Secretary Bessent last week. That sort of saw the fade. We've also got the AI and tech part of the equation as well. The Nvidia price hikes being recorded, Nvidia earnings as well, and a trade war. And at this point, we are hearing the revival of the trade war. Headline, right? Canada seeing long trade war with the US that may last past the midterm. So we're getting a bit more sort of nuance around how that relationship between President Trump and Prime Minister Carney is shaping up, right? The government seeing very little chance of resuming talks with President Trump before the midterm elections after these trade talks collapsed over the weekend. Mark Carney at the moment is focusing on a domestic aid package to help businesses that have been impacted by US tariffs. They'll stay in place for the duration of the conflict and throughout the rest of the Trump presidency if need be. So we are hearing a few more details, according to people granted anonymity to discuss these sensitive deliberations, of course, but really these preparations coming from Mark Carney really signalling just the gravity of the breakdown in talks late Friday, these new tariffs being imposed by President Trump, Carney announcing retaliation, this spiraling trade fight between what should be these two very close and closely integrated economies, right? So we continue to watch and wait to see the broader market impact. We saw it in the Canadian dollar, but the US at this point saying that the path for talks looking unclear as well as they head towards, Paul, by the sounds of it, really kind of an entrenched situation. But take a look at how we're faring in terms of some of that caution for various reasons playing out through to the Asian Open. We're seeing Japanese markets coming online by 0.3%. That softening dollar situation providing a little bit of alleviation of the pressure on the Japanese yen, but certainly it is expected that JGBs will follow suit in terms of the moves that we've seen in Treasuries as well. We're seeing dollar yen at that 158 level. And if you switch out the boards, we're going to take a look at how Korea is coming online, because the Nvidia stories, of course, we do have earnings this week, but also the reports of some customers looking at these price hikes for the servers containing its AI chips. That's going to be front and center there as well, as the focus remains on really the rising expenses within this AI universe, right? That in addition to what we've seen in terms of the Alibaba block as well, the fundraising that we continue to see coming at a very frenetic pace there. Samsung Electronics falling by almost 5% after that shareholder return plan being mulled by investors. SK Hynix, though, putting on 3.5%, Paul.
We've just opened for trade here in Australia as well so far. It's a modestly risk-on session. We're better by about 0.4%. We've got some of the gold miners performing pretty well. Evolution, Northern Star both gaining. This as the gold price gains as well. Although, is it the gold price gaining or is it the US dollar softening? The debasement trade alive and well. And there you see yields for the 2 and 10-year. The 10-year pretty much erased everything it got from what Scott Bessent is calling the Treasury twist last week. That was a very short-lived, and of course we have Kevin Warsh speaking at Jackson Hole to round out the week, and the market will be hanging on every word. Let's get to Dilin Woonar, research strategist at Pepperstone. And Dilin, I do want to start on what we're seeing in the Treasury space at the moment. I mean, we've got yields climbing again. That bounce that we saw last week was very, very short-lived. We're also expecting to hear from the Trump administration this week, unveiling a range of fiscal initiatives to address the problem at the core of all of this. What do you think is needed here?
Well, I think the bond market is obviously ahead of the Fed right now, and that gap is the whole story, I think. The 30-year at 5.3%-ish is a 19-year high, fine, but what actually matters is Bessent announced he more than doubled the buyback program, and the yields barely flinched. And that tells us it's actually a term premium problem and is quite structural. And you've got inflation that won't come down to the target, a fiscal deficit that just printed its worst monthly number since 2021, and a $1 trillion AI corporate bond issuance wave, competing with government paper for the same kind of buyers. So those three things don't go away because the Treasury buys back some bonds. And bond sell-off, I think, would likely to continue until genuine physical discipline or demand destruction, but neither imminent, I think. And in the near term, the long-end Treasury yields will likely stay elevated, I think.
Well, this is arguably making Fed Chair Kevin Warsh's job somewhat more challenging, and we will be hearing from him at the end of the week at Jackson Hole. What do markets need to hear from the Fed Chair in terms of inflation targeting, communication about the Fed's next move, and what kind of market reaction do you expect if it doesn't get it?
Well, I think it would be obviously a really challenging speech for Kevin Warsh, and he has no good options, to be honest. Stay quiet and yields keep running. Financial conditions tighten without a single rate hike, which is almost, like poetic in its dysfunction, and also signal that he's okay with higher long end yields, which some people think is actually his bias or his stance. And you basically hand the bond bears exactly what they need, and push back dovishly, and you hand the inflation hawk a credibility argument. Actually, I think it would be a really challenging or hard task for Kevin Warsh to balance the market expectations of a potential hike, and also he need to consider about a sluggish labor market and also a sluggish retail sales data back to July.
Dilin, a lot at play here when it comes to the gains across the AI space has been due to the relentlessness of the momentum factor, right? As this begins to fade, it's certainly been challenged over the last couple of rounds of sell-offs. Do you see certainly more of a difficult environment for retail investors, but perhaps more opportunity if you're looking to be a little bit more picky and perhaps value-oriented?
Yes, I do think, everything goes up together is basically yesterday, and we really need to potentially find some selective opportunity in the AI trade. I mean, because the fundamental of the demand in AI is still quite intact. AI demand is quite strong. Hyperscalers capex commitment approaching $7 billion for 2026 is real, and a structural supply constraints through the middle of the decade, but the market's drawing a hard line between companies spending on AI and also companies earning from it. Alphabet delivered on monetization in the past quarter. Microsoft passed with flying colors, but Meta was punished because their lack of AI spending discipline. So that divergence widened from here, I think, in the near future. And so I think it's a selective story rather than everything goes up together recently. And we obviously need to look into Nvidia's report to be released on after market close on 26th of August. So if we are seeing solid chip demand and potentially more supply from the Nvidia side, that it could be a potential boost to the AI trade.
Dilin, are investors focusing closely enough or looking at the repercussions enough of the feedback loop between what we're seeing from what the bond markets are doing and the relentless pace of fundraising by hyperscalers and other AI players? Does this at some point come to be a confluence? Because you would imagine this ultimately results in even more expensive levels when it comes to the AI build-out.
Yeah, I think that's a fair point. And I think the interaction effects between the bond market and AI capex is obviously something we need to monitor as well. And the hyperscalers are planning to issue roughly $400 billion in investment-grade bonds in 2027 to fund its AI infrastructure build-out. But the issuance has to be absorbed by the same bond market that's already under structural pressure from physical deficit and persistent inflation. And if the 30-year yield stays above say 5%, the cost of that debt financing rises materially, and it changes the return math when AI infrastructure in the investment in ways that they aren't yet reflected in tech valuations. So if we are still seeing the lack of physical discipline from the long end, from the AI, from the US debt market, then it would be a potential challenge to the mid to long-term development in the AI trade. But in the near term, I think what can bring market more volatility is to Nvidia's report.
Dilin, just finally, copper miners are performing very well in this story. Australia is home to a lot of copper miners, and copper also occurs in similar ore bodies to gold as well, which is also performing well thanks to the debasement trade. With that in mind, how did you like the earnings story from miners, and how do you play the Australian story at the moment?
Well, I think the Australian outlook is genuinely mixed and is suggested by the earnings season. The multi-speed economy theme, I think, is still playing out quite well in Australia. Resources, as we just mentioned, are carrying the load. BHP delivered impact up 30% on record copper prices, biggest dividend in 4 years, and Rio Tinto EBITDA up 28%. Quality Australian names with global commodity exposure specifically are navigating this environment just fine. And the problem is basically everywhere else. Non-resources earnings are tracking around 2.6% growth against underlying inflation of roughly 3.6%, and that's a real contraction in purchasing power terms. And banks are solid, but not that spectacular. Weakening credit quality as well as concerns about a potential economic slowdown kept coming up across different reports. So that tells you the consumer is under some real pressure. And I think, is basically we're looking into a multi-speed growth model in Australia. I think we are still looking a potential upside of all the energy and including copper, this kind of names, but we need to be more cautious about all the non-energy and retail sectors.
Dilin Wu, who's a research strategist at Pepperstone with us. We do have some breaking news. We were just talking about the extraordinary levels of fundraising that we're seeing from a number of the big tech giants. SoftBank Group are planning a 1 trillion yen retail bond sale. We're getting some more details on that, but if it goes through, that would be the largest retail bond sale by any Japanese corporation. The Nikkei did report late last week that SoftBank Group was preparing to issue 1 trillion yen in bonds aimed at the retail market, aimed at retail investors. And we're now hearing confirmation of the same there. And this comes really as we continue to see some refinancing efforts from SoftBank as well, including that of a $40 billion bridge loan that was due in March, really being seen as key to SoftBank Group's credit profile, the bond performance there as well. So we have been expecting over the next few months for SoftBank to continue issuing bonds as it continues to face that shortfall of nearly 30 billion, even after a 10 billion OpenAI linked margin loan there. Some of this would include upsizing the ARM-backed margin loan, selling Intel shares was one of the options there as well. But now we're hearing that SoftBank Group planning that 1 trillion retail bond sale. We'll be getting you more details as they come to us. Speaking of Japan, we continue to watch some of these auto names as well. We just reported earlier some of the contingency measures being planned by Mark Carney's government to deal with the impact of the trade war with the US, which by all accounts seem to be being seen as a protracted one on the Canadian side as well as potentially on Washington's side as well. But one of the impacts in this part of the world, shares of Japanese car makers should see an impact there. We're seeing some downside for Toyota, for Honda, Nissan Motor there as well, falling the most by almost 2% there. We did see some earlier gains in the previous week, though, on the reports that the Trump administration was planning to reduce tariffs on cars imported from Canada to 15% from 25%.
Let's check in on PLS. This is a lithium miner based here in Australia, seeing a reasonable bump in its price at the moment, better by 3.5%. This is after reporting a return to annual net profit, a net profit of 525.8 million Australian dollars. That was a miss, but it does reverse the net loss that we saw a year earlier. PLS also going to be paying out a final dividend of 5 Australian cents per share. That's a payout of about 22% of adjusted free cash flows. So reflecting their rebound in fortunes for lithium. And PLS Managing Director and CEO Dale Henderson is going to be joining us in the next hour to discuss the company's business outlook following those earnings. More ahead on the Asia trade. This is Bloomberg.
This week, Bloomberg is live at the Jackson Hole Economic Symposium. Tom Keene and Lisa Abramowitz, along with Michael McKee, will bring you news and interviews with Fed leaders, policymakers, and economists shaping global monetary policy. Tune in for continuing coverage and a special episode of Surveillance, August 28th at 9 a.m., including full coverage of Kevin Warsh's first speech to the conference. The Jackson Hole Economic Symposium on Bloomberg. Context changes everything.
Let's get you a quick look at SoftBank in light of really the confirmation that news that we had started to hear a little bit about last week, which is SoftBank planning a record 1 trillion yen retail bond offering in Japan. So $6.3 billion is where that would be in terms of US terms. Retail bond sale in Japan. SoftBank raising funds for its investment commitments to OpenAI. 7-year bonds that we're looking at expected to be priced on September 4th, an indicative coupon range of 4.3 to 4.9%, according to a company filing. I believe this would be the largest ever by any Japanese corporation in terms of that retail offering. We also had news of Alibaba's placement as well. Let's bring our markets reporter Anthony Stevens joining us now from Hong Kong. Anthony, it's interesting. We were just talking to our last markets guest about kind of the circular feedback loop of these pressures in terms of the Treasury markets and debt concerns and funding costs in the US. At the same time, these tech giants are just, it seems like we're struggling to keep up with the number of fundraising efforts and financing efforts that's happening at the moment. Is there cause for concern?
Well, it really depends on the company, right? And the specific credit that you're talking about. The flood of paper that is coming to the market seems to be up and down the capital structure based on what is most appropriate for the company. So let's take SoftBank, for example, right? This is a 7-year deal, around $6 billion. But still, the yield that the investors are getting is in the realm of 4.3 to 4.9%. That compares very favorably with 30-year JGBs. So you can see how this private credit, this privately issued credit, is going to compete now with the governments, right? That we are in the same kind of yield levels, and fixed income investors will be very hard pressed to turn down these kind of numbers, especially in a fast growing sector like the AI trade, right? So that is the competitive element of this capital competition between the governments and the AI trade. That is becoming a much bigger factor as the numbers start to catch up, right? You have sovereign size issuance. Like you take another example with Alibaba trade, right? That's $10 billion. That is a material size that compares to a treasury auction. It's the biggest ever secondary placement in Hong Kong. So now you are entering a realm where pricing of these deals is coming tight on the private level, but the auctions are struggling at the public level.
Anthony, also comes at a time where Nvidia is putting its prices up. Talk to us about how much, for what products, and what are the implications of this? How's it going to be felt downstream?
Yeah, the pricing increase is reportedly in and around this 15% number. That is closely tracking some of the increases in price of input components, most notably memory, which trades on a spot basis, so you can kind of verify that. So they're passing through some of this increased cost to its customers. Now, the take-up from these customers will be very interesting to watch, because some of these customers are making their own custom chips, right? And that will probably accelerate that development. If you continue to see this pricing power from Nvidia, the likes of Google, Amazon, and Microsoft will be even more incentivized to make their own chips. That plays into Asia in a very complex manner. You see that the suppliers to Nvidia have done fantastically well this year, many triple-digit gains amongst them. And then the customers of Nvidia are also the smaller Taiwanese players who've done really well. So both sides, can they continue to benefit as Nvidia increases prices? That is a bit doubtful.
All right, markets reporter Anthony Stevens, thank you. Now, as Anthony mentioned, Alibaba is seeking to raise about $10 billion from a Hong Kong share sale as it ramps up AI spending. Let's get more detail now with our China correspondent, Min Min Lo, in Hong Kong. So, Min Min, what are the details of this sale? And it's certainly not without its critics either.
That's right, Paul. Alibaba is looking to offer 700 over million shares at a discount, a 3.6 discount to its US ADR closing price on Friday. Now, mind you, Friday's closing price was about 8.5% lower, huge trading volumes as well. A part of it could be because of its earnings, because its profits were down 75% on year on the back of the strong investment, close to $10 billion in investment in the last quarter alone. And the company says they want to continue investing in this full stack AI services. But yes, you look at the share performance year to date is down about 14%. And you have prominent investors like Michael Burry, for example, saying that he has exited his position in Alibaba and shifted to buy JD.com stock instead. He says that the price competition might be easing and it could benefit companies like JD.com and Meituan, but he's not convinced about Alibaba's spending, saying that the ROI may not improve even as Alibaba is making inroads when it comes to what he calls the bloodbath in the commoditized LLM sector. So it's certainly one that we will want to keep an eye on when market opens today.
Bloomberg's China correspondent Min Lo there. All still ahead. A Canadian envoy tells Bloomberg that US trade talks collapsed over the fine print as Canada plans retaliation for Trump's 50% tariffs. This is Bloomberg.
Bloomberg sources say Canadian Prime Minister Mark Carney's government now sees little chance of resuming talks with President Trump before the US midterm elections in November. And a Canadian envoy has told us the negotiations unravelled over the fine print in a proposed agreement. Bloomberg editor John Herskovitz joins us now with more. So, John, looks like it was the devil in the detail that brought this undone. But in terms of this dragging on into the midterms, what's the play here? Could this potentially, is this a bargaining chip?
Yeah, I mean, for Canadian Prime Minister Carney, he is, as our reporting says, he's preparing an aid package for the industries that are hit by the tariffs, and he's looking at something that's going to be prolonged. He's preparing his country for several months of trade dispute with the United States, at least through the midterms, as our reporting says. So for him, this is a shift in the priorities. He spent a lot of his first year trying to cool down tensions as much as he could with the U.S. Now he's preparing for a prolonged trade war. He has the public behind him, according to polls, so he's standing up to the U.S. in the way that China stood up. He's matching the tariffs dollar for dollar, and the public seems to be behind him on this. So he's preparing the aid package, and we'll see if and when he does roll it out.
In terms of the impact in both countries, the US is obviously a much bigger economy, but we're also hearing that Prime Minister Carney is preparing a package of support measures for some of the industries that might be impacted.
Yeah, I mean, in terms of the overall trade, the trade between the two countries is about $900 billion annually. So the $20 billion it's not a big in terms of the overall trade. But there are a lot of implications that go on with this. One is the risk of escalation of this dispute between the two countries. The other, there are some domestic political considerations in the U.S. And overall for the U.S. economy, it's not a lot of money. But there are a couple of states that have a lot more trade with Canada and are key for the upcoming midterm elections. These would be Michigan and Ohio. One of the disputes that led to the breakdown was over medium and large trucks. Michigan is involved in the supply chains with these. Ohio manufacturing is also involved in supply chains with Canada. There are contentious races for the midterms, which could determine the balance of power between Republicans and Democrats. So this is something to keep in mind as these talks go forward, as it goes forward.
Bloomberg East Asia Government Editor John Herskovitz there. We do have much more coming up here when it comes to the US-Canada trade dispute. The former Canadian Trade Minister will be joining Insight with Haslinda Amin. Let's get a quick look at how energy markets are sort of just chugging along, really, given we don't have a great deal of progress when it comes to what's going on with the US and Iran. We do know that Treasury Secretary Scott Bessent is set to unveil some more details when it comes to the US economic isolation plan for Iran. That's kind of the latest thing that's in progress. That's expected a little bit later in the US on Monday. But New York traded crude, we're seeing oil dropping after 2 weeks of gains there as the market kind of continues to wait as these global supplies of crude continue to be choked. Refined fuels, LNG, of course, all being impacted. Oil, despite some bouts of volatility, still up more than 50% so far this year. Well, China says it continues to support a diplomatic end to the US-Iran war. Beijing released a statement to that effect almost a week after a meeting between the Chinese Vice Foreign Minister Miao Deyu and his Iranian counterpart. The timing is notable because it comes just before the US says it will unveil these measures to punish Tehran and its economic partners. Let's bring in Christopher Smart, a managing partner at geopolitical risk and investment consultancy, Arbroath Group. He previously served as a special assistant to President Obama at both the National Economic Council and the National Security Council. Christopher, always a pleasure to have you with us. And as you asked, what are we going to talk about? Because we haven't heard a great deal of progress in terms of what's going on with this, what feels like an increasingly intractable stalemate. This economic isolation plan that we're waiting for details on. What are you expecting, given that, well, Iran is and has been for a long time economically isolated?
Well, I think a lot of us are going to be interested to see what Secretary Bessent has to say tomorrow. I think he wrote a piece over the weekend that announces or describes what he's about to announce as an economic D-Day, sort of the beginning of a final assault on the Iranian economy. But it feels like, as you say, this is something we've been working on for more than a decade or maybe several decades now in terms of isolating and sanctioning the Iranian economy. I think a couple of things spring to mind right away is we really have very little sense of how bad things are within the Iranian economy right now. We know it's bad, but we're not really sure exactly where the pressure points are. And then secondly, you know, this is a regime that is not popularly elected, not facing any midterms anytime soon. So even if the pain gets worse for the people of Iran, it's not clear how that's going to change their behavior or any of their negotiating positions.
Does the greatest impact potentially come down to what Beijing and what Russia can be persuaded to do? And we do know that President Xi is expected to head to Washington in September. Is there any leverage there for President Trump?
Well, I mean, as you say, the biggest trading partners are China, and we have a whole lot of other business to do with China beyond Iran. So I'm not sure what kind of leverage the president expects he can exert, other than maybe tariffs or sanctions. But we also know that the Chinese aren't just going to stand and take it if those sorts of threats are raised. And so they have played their cards before, responding with both sanctions as well as blocking critical mineral exports. And so I'm not sure that's a game that the president wants to start playing at this stage. You know, the other key players in the region, Afghanistan is on one border, Turkey and Russia are on northern borders. Not clear we have, you know, any relationship with either Afghanistan or Russia. Turkey might be able to help out, but it's not clear that that's at the top of their list. I think the one encouraging point that the president and the Treasury Secretary can look to is the announcement earlier this week that the United Arab Emirates was going to stop all of its economic relationships with Iran. That's been a key conduit of a lot of money in and out of the country. The question will be, is the government able to crack down on illicit and illegal flows back and forth?
Christopher, part of the whole rationale for this conflict in the first place was to prevent Iran from getting a nuclear weapon. But a couple of thoughts here. Does this entire experience reinforce the Iranian desire for a nuclear weapon and sort of prove their point to a degree? And in terms of economic isolation, Exhibit A, North Korea endured decades of economic isolation, got a nuke anyway.
Yes, you know, you make excellent points all around. I think others have pointed that out as well. The attacks on Iran, as you say, reinforce the case of the hardliners within Iran that this is something that needs to be done. Now, obviously, the bombings last year and then this year have done a lot to set back that program. But I think expecting to resume a course of negotiations that requires trust to be built on both sides and requires inspections and transparency, and Iran to trust the fact that its security is not threatened, have been delivered a big setback right now. The question, though, remains, I think, what good does a nuclear weapon do for Iran? Maybe it helps it avoid another attack like this. But to be honest, I think what we've demonstrated all from what's happened in the last 6 months is that attacks like this don't really work. They don't really change the behavior of the regime in the way you want to change it. And in fact, has opened up these problems on the Strait that we're all dealing with.
Well, the regime's been around since the 1980s. President Trump this term's been around for slightly under 2 years. You mentioned earlier the Iranian regime doesn't have to face midterms, but the president does. Is that part of the play here to make things extremely uncomfortable for the US? Do you expect any retaliation from Iran in the hope that they might be dealing with a new regime, a more sympathetic one in the United States, a couple of years down the track?
Well, 2 years is a long time for the difficulty of having lost their access to global oil markets. The strait being closed is inflicting pain on them. I'm sure they would prefer not to have that blocked the way it is right now. And to expect that to go on another 2 years, I think, is probably something they would love to avoid. But I think the real question is just the imbalance in I guess, steadfastness, for lack of a better word. I mean, Iran is defending its country. It's never going to give up on that. And the hope is that the U.S. will either get distracted or realize that the costs of continuing this effort, militarily as well as economically, are too high. And so it feels like we're still going to have to come to terms with some kind of agreement that neither side loves. But we're clearly not there yet, and we're going to have to see what the secretary announces tomorrow. You know, I'll just say as an aside, he has had two big announcements in the last 2 weeks with the yen intervention and then with the buybacks of the U.S. Treasury debt. You know, his credibility has been dented in the past couple of weeks, and so it's not clear that he's going to be, you know, restoring or reinforcing that reputation with whatever he's able to announce tomorrow, unless it's something completely surprising.
Christopher, at one point, this felt like a war that needed to be dealt with before the midterms. As we get closer to November, it feels like the kind of incentive or interest is lapsing, right? Is this just setting up for kind of a continued war of attrition, potentially beyond midterms?
Well, I think we're in a position where, if we're lucky, things will stabilize into a kind of a neither war nor peace. Maybe there's no agreement, but maybe ships are allowed to pass. Maybe not the flows that existed before the war. The broken trusts between the U.S. and Iran are going to make it very difficult to tackle these bigger issues right now. But I think the hope is that things will be able to at least get back to some more normal set of flows in the next few weeks or months. The president, I think, would have been delighted to get things over with a few months ago, but I think what he didn't realize that once he started this, it wasn't really his to decide whether to finish it or not, because the Iranians have that choke point in their hands.
All right, Christopher Smart, Managing Partner at Arbroath Group. Thanks, as always, for your insights. And we have more ahead on the Asia Trade. This is Bloomberg. Samsung is rolling out the largest shareholder return program in South Korean history as a surge in demand boosts earnings and cash flow. The company plans to return as much as $80 billion to investors, joining SK Hynix in sharing the gains from the AI boom. Asia Stocks reporter Yu-Kyung Lee joins us now with more from Seoul. Yu-Kyung, we are seeing Samsung shares losing a bit of ground in Korea in the early going. Why are investors disappointed by this shareholder return package?
Yeah, Samsung shares fell 7% when I last checked, and investors are deeply disappointed because of the lack of share buyback or cancellation details. Now, Samsung announced the biggest shareholder return in South Korea's history, 110 trillion won, $80 billion, including 30 trillion won of cash dividends during the third quarter. However, the company also said investors should wait until January board meeting to see how much of that proportions will be allocated to share buyback and cancellation. Now, JP Morgan just said the company's announcement failed to positively surprise and is going to serve as a near-term disappointment to investors. And it pointed out the absence of buyback program and Samsung's prioritizing cash dividend over share buyback, which investors much prefer. as a reason for the near-term disappointment. So this is going to serve as a disappointment to investors.
Why are these risky structured notes popular again in the South Korean market?
Yeah, switching the topic to this risky structured note called equity-linked securities. After a historic sell-off in July, South Korea's stock market saw a historic sell-off. Investors are finding an attractive entry point to these risky, complex structured note called equity-linked securities, which promise returns of annualized coupons of 40% to 50%, and they're often tied to stocks such as Samsung and SK Hynix. And as long as the underlying assets stay in the preset ranges, they promise these juicy returns to investors. There are renewed interest from mom and pop investors in South Korea to these risky products that have burned investors in the past again and again. And I think because when assets are moving in sideways and Kospi has been moving in the range bound between 6,000 and 7,000, these structured products often rise as an attractive alternative to investors looking for juicy returns. So we saw July issuance rising to the highest since April 2023, and as long as Kospi trades sideways, we're expecting renewed interest from retail investors to these risky products to stay for a while.
Bloomberg Asia stocks reporter Yu Kyung Lee there in Seoul. Well, unprecedented shareholder return plans from South Korea's two chip-making giants are emerging as a key driver of gains for the won. Our chief Asia FX and rates correspondent Ruth Carlson joins us now for more. So what are strategists saying when it comes to the signals for the won's path from here?
Yeah, absolutely. I mean, that AI investment boom is really playing out also in the macro space. So while some Samsung investors might be disappointed, look, on the macro side, the won is very much bid. As for what strategists are actually saying, you know, if you look at the FXFC function, you've got strategists out there who are saying, you know, 1350 as another level that could be hit. Option traders are also signaling further gains. All in all, investors are looking at this going, there's going to be more demand for won here from all these shareholder buybacks, whether they're going to actually fund it by, you know, converting some of their dollars back into the won or from their cash reserves. Either way, it's good for the won.
What about trader positioning on the won and just how far that rally can go?
Yeah, absolutely. That 1400 level that was breached last week was very, very telling. And it shows positioning that is bullish on the Korean currency. And if you look at what option traders are signaling, for example, you know, they see a 30% chance that it could, dollar won could trade around 1300 by the end of this year. And even 1200 is a possibility by the second quarter of next year. So all in all, pretty bullish path from here.
What are some of the risks to these positions?
Yeah, absolutely. Currencies, foreign exchange are notoriously difficult to get right on the money every time. And remember that the won is high beta, often seen as a barometer for risk sentiment in Asia as well. And we know that the Iran war is still raging. We know that South Korea is one of the world's biggest importers of energy as well from the Middle East. So if inflation concerns, you know, sort of turbocharge as a result of the ongoing war, for example, or even if sentiment gets a hit, the won would definitely be a potential casualty.
All right, Ruth Carlson, Bloomberg's chief Asia FX and rates correspondent. Thank you. Let's get to the top corporate stories that we're tracking. The Japanese government is said to be allocating an additional $944 million for chip startup Rapidus. The source says the administration will seek more funds for the contract chip maker in its fiscal 2027 budget. Rapidus is aiming to compete against the likes of TSMC with plans to begin producing cutting-edge 2-nanometer chips by next year. Sinopec has reported a 12% rise in first-half profit as a surge in global energy prices boosts upstream revenues, even as it sees squeezed fuel sales. Preliminary net income was about $4 billion. Higher prices also increased the value of Sinopec's oil stored in tanks. We have more ahead on the Asia trade. This is Bloomberg. Asia is heading into the busiest week of its earnings season with about 370 companies in the MSCI Asia Pacific Index due to deliver results. CXMT will report for the first time since its blockbuster IPO, with investors looking for signs the memory chip maker can build on the AI-driven optimism that helped make it China's most valuable company. Makers of AI hardware, from optical modules to printed circuit boards, will also be in focus as Eoptolink and Victory Giant report earnings amid strong sentiment across China's AI supply chain. BYD, PetroChina and Lapu Gold will also offer fresh clues on the strength of China's consumer recovery. Now, investors are also digesting Alibaba's plan for a $10 billion Hong Kong share sale. Anthony's back now with us for a look at how traders are positioning for the market opens in Greater China. And Anthony, we've seen some interesting moves with SK Hynix and Samsung today. Is it going to be a case of hold my beer from Alibaba?
Yeah, very, very interesting, right? You do have these big deals, these big shareholder return policies. Like, there's a lot happening at the top end of the MSCI Asia Index, right? So let's get the Samsung and Hynix thing out of the way very quickly. We have the street reacting to Samsung's shareholder return program. They are not very impressed. This is a huge spread between Samsung and Hynix this morning to start, and it's worth watching this develop as the day goes by. It's weighing on Kospi. Now, to come back to Alibaba, the size of the deal is really something. At $10 billion, it's the biggest deal in secondary market action in Hong Kong history. And it came really quite tight, right? We have to reiterate that it's about 3 days worth of volume if you add the Hong Kong and the ADR lines together. And it's trading only at around 1 sigma move. So 1 standard deviation move down. So the investor base clearly wants more Alibaba shares, especially after that result, as it seems to pivot into being a cloud provider and less emphasis on the e-commerce business in China that is flagging. So in terms of the fundamentals, it seems to be pushing in the right direction. Now, the size, though, remains a big problem, right? This is a lot of money for the Hong Kong share market to digest as a whole, let alone Alibaba stock in isolation. Hong Kong shares normally trade around 40 to 50 billion USD overall. So as a weight over the market, this continues to be an overhang. The HS Tech has really underperformed broader Chinese indices. The KWeb ETF in the US has been a laggard of the AI trade globally for a very long time, and this does not seem to be contributing, right? On the other side of things, you have to think about what are they going to use this money for? And that is going to be to continue to build out the cloud infrastructure that they have in China. So you do see the likes of the Chinext index, the Star 50 index, looking to benefit, and that is why the results that you mentioned at the top half would be closely watched, right? So CXMT and all these Eoptolink optical names, do they benefit from this continued cloud build-out in China?
Got a couple of IPOs to watch as well. The Chinese chip maker Yangtze Memory Technologies, as well as more of a household name, Shein.
Yeah, the Shein one is interesting, right? They probably missed their window here a little bit in the sense that it's much less buzzy than it used to be, and it's competing with all of this AI paper, and you just do see the reflection of the scale, right? Like you're in like the Alibaba block is at around 10 billion, and this consumer name is coming in below 2 billion. So you see that the AI trade is multiples larger than literally anything else. That being said, this is one of China's innovative brand name companies. So how well it does will be a really interesting reflection of the market's faith in China's ability to innovate on the consumer side, to create brands that people want to buy and to be able to distribute them globally. This company is also interesting in that it's in the crosshairs of the Trump administration as far as de minimis taxes are concerned. So how that plays out in the stock will be super interesting. YMTC, on the other hand, is on a much, much more firm fundamental grounding. NAND prices are going through the roof, especially the simpler NAND that YMTC is making. And YMTC, nicely timed, entered the top 3 for NAND supply globally. So it'll be interesting to see how oversubscribed that IPO is and how well it does on day one. The fact that Chinese IPOs are priced to do well on day one will probably serve this stock really well. And instead, the comparison will be versus its peer CXMT.
Markets reporter Anthony Stevens there. Robots. This is a great video from the weekend, right? This is from the Robot Games, the second World Humanoid Robot Games, with 51 events, over 1,300 matches involving more than 600 teams and more than 2,000 robots. Now, the beating when it comes to Usain Bolt's 100-meter record was obviously the highlight. I do just love watching this. It did manage to stop, though. Usain Bolt didn't do that. It didn't, he didn't run into a wall.
It didn't need the cushion, no.
No, it didn't need a cushion to stop him. But at least he managed to get through the whole, that this robot managed to get through the whole race without crashing, because we have seen some pretty devastating / hilarious instances of these humanoid robots kind of going.
Yeah, it's reliably amusing. I mean, I've seen a gate like that in my local park from some joggers, so they're getting quite...
I look a bit like that when I try to do athletics, if I'm honest.
But the whole running into the wall thing, it does underscore this ongoing problem with robotics. I mean, they do have what's known as narrow artificial intelligence. They do one thing extremely well, but not things like, stopping, or in the case of Usain Bolt, understanding cricket. I mean, this is pretty much it for the robots. They run super fast. If you're superstitious, there were actually 666 teams involved in this competition, but we'll just move swiftly on from that. Look, other limitations, I mean, there are tennis-playing robots. There's one on fire that can do a backhand. I'm not sure why you bother teaching a robot that when you can just make it ambidextrous. But also there are balance issues which we're seeing here, limited autonomy, battery constraints as well. But look, if we know one thing about technology, Heidi, is it gets better, not worse.
It does. It does. Perhaps we need to... Oh, the boxing looks good as well there. I still like the Kung Fu choreography from the CCTV Spring Gala. We'll have to leave it there. We're not quite sort of there yet when it comes to the Olympics being taken over by humanoids. But that is it for the Asian trades. Our markets coverage continues next with the start of trading in Hong Kong, Shanghai and Shenzhen, and the China show is next.